Welcome back. Now that we've given you the methods for picking the right currency pair, identifying the most relevant information and economic indicators, and how to research and analyze effectively, it's now time for you to formulate a trading bias. By doing this, you're going to use your analysis to predict the direction that you think the currency is going to trend in. You could form a bullish bias, meaning that the currency is going to form an upward trend. You could form a bearish bias, where the currency is going to form a downward trend. Or a neutral bias. In this neutral bias, the price of the currency is going to fluctuate between two price points, forming a range. This is where technical analysis can come in. Because after you form this trading bias, it's time to create your entry and exit points. Using technical analysis in the form of EMAs, tools, and indicators that are taught previously in the technical analysis course that we have, you can now combine this with your fundamental analysis to either confirm or reject your trading bias. For instance, you can set up a few moving averages and support and resistance levels that will be able to display your trading bias on the charts, thereby bringing further confirmation to your fundamental analysis. In fact, the best traders are able to combine the two, technical analysis and fundamental analysis, to execute good trades. And finally, it's time for you to monitor and adapt. You've done the hard work. You've already formed your opinion, but don't rest. Don't take it easy. You need to keep up to date with economic news and market updates and what's happening on the global scale, because any little piece of information that comes up can lead to your bias changing direction or changing course. Or it could even further add confidence to your bias, because then you can now alter your trade and you can now capitalize on opportunities. So it's important for you to stay up to date on what's happening, because a government can come up with a surprise announcement. A court decision can happen at any day, and global geopolitical events that arise to public awareness may have happened a long time ago. For instance, ask your friends, when did COVID-19 start? We all felt the impact of COVID-19 in 2020, but it actually started in Wuhan, China, December 9th, 2019. At that time, Euro was trading at $1.115, and the markets weren't too sure how to process this information that, oh, there's been an outbreak in a lab facility in China. Nobody really knew what was going to happen. A few conspiracy theories were there. It wasn't until the awareness reached global level alerts when the World Health Organization, WHO, puts the alerts on that, oh, there is a COVID-19 pandemic on December 20th, 2019. Even then, the euro only fell about 2 points to $1.113. At that time, could you have predicted that 3 months later, the United States was going to lock down their borders and restrict all travel? That the world was going to shut down for a period of time? If you had predicted that, you would have been able to gain 3,570 pips on the euro, all because of the US lockdown and the world locking down. Now, the fundamental reason why there was that type of gain is because, one, with the US lockdown, there was a restriction to US trade, US goods and services, and supply chain disruptions. If it's hard to get US goods and services, that means you're probably not going to need them as much. And therefore, you're not going to need dollars. Demand for dollars dipped. Then, in order to support their economy, the US reduced interest rates to negative levels. That way, businesses had the financial support to keep running and to not miss their own financial obligations, which further reduced the demand for the US dollar. That's why it's good to have an understanding of fundamental analysis, because if you knew, or if you could even have understood the potential impact of COVID-19 when it was first announced, you could have placed a small trade. Something that's wouldn't take too much out of your capitals, low risk, and you could have gotten a high reward. So, to recap, in this module, we taught you how to pick a good currency pair, what to look out for. We taught you how to identify relevant information and about economic indicators that the market is paying attention to. We taught you how to research and analyze in a streamlined manner so you can avoid noise. Then we taught you how technical analysis can be used to formulate your trading bias and your entry and exit points. And finally, why it's always important to monitor and adapt to market updates so that you can catch little news and make big gains. So I'll see you in the next video. Thank you for watching.